welcome. And we will be going through three different sections in today's webinar. We have my colleague John Mulcahy with us. Jose sends his apologies. He's been stuck on a flight in Barbados for the last day or so, had to make an emergency landing there on his way back from South America. So he's enjoying the beach and not the webinar with us. But onwards, so today we're going to be going through a little bit about what our views are at the moment on the lithium market. Obviously, prices are at very low levels at the moment, and we're talking about some of the things we think are likely to change and break in that market in the coming months and years. We're then going to talk a little bit about the cathode supply chain, in particular, cathode supply chain outside of China, because again, that's facing a number of risks at the moment, and certainly for those more interested in lithium, that's effectively where your lithium is getting shipped, even if it's not the people directly buying the material from you. And then thirdly, John's going to take us through some of the risks that raw material price volatility is really sort of bringing to the industry in the coming months and years, and in particular how a lot of the OEMs at the moment are not really doing a particularly good job, at least in our view, of managing that risk. So we'll talk through some of the strategies that can be employed there. But starting off with the lithium side of the market, and I'll start off with the good news, to be honest. The good news is that the demand side of the market is still booming. We've been surprised on the upside by the strength of demand. I think at the moment, our 10-year forecast is still for 20% compound average growth rate, or an over 20% compound average growth rate. The transportation sector seems to be brushing off a lot of tariff worries. And there are a number of factors influencing demand there. Obviously, in the Chinese market, the largest automotive market, we're seeing, very strong product launches. We're seeing a price war at the moment, which is really sort of burning margins and making EVs incredibly cheap there, even in comparison to internal combustion vehicles. And indeed, the China definition of new energy vehicles sales were over 60% in the last month's worth of data. And many forecast that to be over 70% by the end of the year. In Europe, sales also incredibly strong. Most of the headlines you'll read will be about, Tesla's sales collapsing in Europe, excluding Norway, but the rest of the market doing very strong. Partly that's because of one-off subsidy rollbacks that happened in 2024. So effectively, a lot of the subsidy shocks that we've had have already happened in Europe and the major Western European economies. We're seeing a large number of new product launches. We're seeing those new products being substantially better in terms of energy efficiency, in terms of price point, in terms of range. And yeah, that's encouraging that sector quite a bit. North America, a little bit more mixed, and obviously it's going to be very dependent upon what happens with those 30D tax credits and what happens with some of the new product launches and planned product launches, which are very much up in the air as we move through the current legislative agenda. The big sort of interesting risk that comes to this picture, though, is really, and it's worth highlighting, it's from the energy storage system side. So you can see there the light green bar. And interesting enough, when we look at the demand forecasts on transportation, pretty much all of the analysts and consultants out there have a very similar view now. There's not a huge amount of change in what we expect to happen. And there hasn't been in the past few years, to be honest. We're not seeing these wild changes in demand forecasts. We are, however, seeing them in ESS. And if you take CATL, for example, obviously they've got a bit of a vested interest, but their forecast is for 1.4 terawatt hours of ESS demand in 2030. Now, we have that, I think, 875 or something like this. Some analysts have it at 500. And, that's absolutely huge, the discrepancy in just, 4.5 years' time as to what the size of that market will be. And to give you an idea, that's the equivalent of 18 average size lithium operations in the discrepancy of about 500 gigawatts between us and CATL. So yeah, big questions there over that, and obviously that has an impact on how much lithium we need and how we're going to balance these markets going forward. Looking at the lithium price itself, welcome return to the lithium rainbow. This is something we first put up a few years ago, and to be honest, it's a bit of very high level analysis. It's held up pretty well, and we are now down in the red, which is wait for cost deflation and wait for the markets to rebalance. And I think that's pretty much where we are. We've already seen delays in capex. We've already seen people try and reduce opex across projects. Now we're getting to a really sort of bad position for a lot of the cost curve, and we'll look at that in the next slide. Indeed, lithium prices their lowest since February 2021 for carbonate and hydroxide. Only December 2023 for spodumene, but there was a sort of brief dip there that they subsequently bounced back from. Interestingly enough, the supply is still increasing. We're expecting 7% supply growth this year. Those are largely projects that reached final investment decision over 2 years ago, and you can see there that prices back in 2023 were obviously incredibly high, and still high for a sort of large parts of 2024. So effectively, these are decisions, this supply that is coming on. These are final investment decisions that were made in a different pricing environment. Demand for what it's worth for lithium, we've got going up 17.5% this year, almost 200,000 tons of lithium carbonate equivalent basis. That also hides a little bit of destocking in the market as well. But let's say the number of final investment decisions has collapsed in a market that's still growing incredibly strong. And that sort of starts putting us into this, what we view as a very unsustainable position. Interestingly enough, just in the past couple of weeks, we have seen hydroxide in China regain its premium to carbonate. We had seen, because of the growth in LFP cathode in China, a large sort of premium developed for carbonate over hydroxide. There's a lot more demand for carbonate than hydroxide. That seems to have switched back to its historical position now, and potentially that's a sign of a slight rebalancing in the market. That said, what I think is clear at the moment when we start talking about any price nadir or potential price rebound is that certainly for the rest of the year, I think our view is that a price rebound would be tempered by potential near-term supply to the market. So there are a few operations out there who build up their internal stockpiles, who, if it's in the money, could release material to the market in weeks or a small number of months' time. That is a limited supply, but we know that supply is there and it's not being used at the moment. So I think prices move back towards $10,000 per ton. We would see a modest supply response relatively quickly. It doesn't involve bringing on new pieces of equipment and new assets into the market. So where are we on the cost curve? Effectively, this cost curve, we've tried to make it as all-inclusive as possible. So this is effectively your incentive price curve. And the idea there is that if you draw a line against where the price is and where the cost is, you'll get an idea of what free cash flow generation is at these projects. And we also include capital repayments when we're looking at these projects as well. So you see, if we go back just about 18 months ago, vast majority of the cost curve is incentivized in November 2023. It decreases quite rapidly to December 2023. By the time you get to the beginning of this year, you're down at that sort of $10,000 per ton level, and about half the cost curve is really feeling quite a lot of pain there. And a lot of people are starting to operate at a loss as well. And indeed, we've gone even further down to the June 25 position. And our view there is that, only really the first quartile is making decent money at these prices, and they probably wouldn't even call it decent money because most of those also own assets further along the cost curve as well. What is clear is that, if you look at this as, the price levels that are required to incentivize new production so that you can cover your debts, you can cover, maybe make a small margin. The current situation is completely unsustainable. You're simply not going to bring on a huge amount more supply in today's price environment. And there's no way that you'll meet demand forecasts that us and all the others have in today's pricing environment, because you'd be insane to bring the supply on. And that's not just happening in lithium; it's happening in a number of the critical minerals and critical raw materials. But it's very pronounced in the lithium market. So a question that we get asked a lot is, why is the lithium supply response so slow? We expect when people are losing money, they drop out of the market rebalances, and we all carry on with our lives. Why isn't that happening at the moment? Well, some of this is down to the uniqueness of the lithium market and just how rapid its growth has been. The really sort of important thing to note here is you can see the sort of growth in supply on the chart on the left-hand side, but you can also see the number of producers. And a lot of these are companies who only have one producing asset, who don't necessarily have revenue streams from other commodities or from other assets. And obviously, the vast majority of those assets are undepreciated. They've got high levels of debt repayment, and it just makes more sense for them financially to continue to producing at a loss than basically closing the company down. And we know from a number of conversations we've had that that's exactly the decision that quite a few of the current lithium producers have had. The other thing that's really interesting about this is that, a large amount of the non-Chinese supply is sold under contract. And, we often call them take or pay contracts. Effectively, in a loss-making scenario, they are supply or pay contracts. So if you're a producer who's currently losing money and you have a take or pay offtake contract, well, if you don't supply that material, then effectively your customer has to go out and buy that material from somewhere else. They can also then sue you for the cost of buying that material. That's very clear in all of the contract terms. So in many respects, the contracting structure that we have, which itself is down to the fact that, lithium doesn't purely trade as a commodity. You don't have interchangeability. You can't sell it on a liquid terminal market, like a futures exchange. You need to have that direct contracting. You need to have qualification. You need these take or pay off takes. And at the moment, those take or pay off takes that everybody wanted, quite often they're trying to get out of them because they have to supply that material, even if they're making a loss, because ultimately they would get sued and lose access to their asset. Anyway, another reason that some people can keep producing is on the floor pricing side of things. A number of contracts do have floor prices, whether they're set at, 9, 10, 11, $12,000 per ton. What I would say is that, floor pricing sounds all well and good, but typically what happens when that floor price is met is there's a renegotiation of what the floor is. That's something again that we advise on and advise on disputes quite a bit in terms of renegotiating what's happening with floor prices or how long they're there for. So there's been a lot of renegotiation going on happening in these take or pay offtake contracts and in these floor prices in particular, and also what prices are referenced in those contracts as well. So looking forward a little bit on where do we see the lithium market with lithium price going from here? Well, our base case at the moment, actually shows the lithium market moving into a small deficit in 2026, and then that continuing for the next couple of years. Obviously, that's dependent upon continued demand growth, so we're not expecting any massive economic shocks from trade wars and tariff wars, etc. That is obviously still a possibility. What is interesting, though, is when we move into this deficit position, and you can see on the right-hand side that we expect the price to increase as we go into this sort of more structural deficit, is a lot of the second and third quartile projects that we modelled here in the cost curve, they're still going to be several years away from production. Even if they're ready to go to final investment decision very quickly. And what's interesting about the lithium market is you've got a lot of sort of almost artisanal material or direct shipping or low grade ores, some of the Chinese lepidolite, etc., which is actually quite a bit closer to the market in terms of its supply elasticity. So actually, what's quite likely to happen is that you actually end up seeing a lot more of the fourth quartile of the cost curve coming on stream before the second and third quartile. And what's interesting about that is, that means you're likely to see a lot more of the lower cost, or sorry, higher cost African supply, which you will find plentiful Chinese refining capacity, while we start seeing investment decisions happen again in Brazil and in Western Australia, who will then sort of lower the cost curve by coming in the middle of it. At least that's our view as to what's likely to happen there. Finally, on the lithium price, I think it's worth mentioning that it's really important to watch the sort of days of inventory in the supply chain, because that's what determines market tightness, sentiment, and price strength. You can see there that we are actually starting to see a slight decline in the days of inventory already, and that we view that as reaching critical levels towards the end of this decade before the sustained supply response comes on. And really, it's only price that's going to be able to respond to help balance the market in that situation. Um, Before we move on to the next section on cathodes, John, any final comments that you wanted to make on the lithium side of the market?
Thanks, Andy. I just think, one critical point to bring up here is in relation to obviously financing of new projects. The low pricing environment we're currently finding ourselves in is obviously incredibly challenging for new projects to find financiers at this point in time. And, as Andy's correctly pointed out, we're likely to move into a position where there's going to be significant demand for new material over the coming years. And the problem we're going to face is effectively these new projects are not going to come online in time effectively to meet that new demand.
So another boom bust cycle as we expect for lithium, but certainly more boom than bust from where we are now. Um, Obviously, a lot of the impact from that is, where is this material going? What's happening with Western supply chains? And we also get asked, a huge amount about what our view is happening between, LFP and ternary cathode in the supply chain. A lot of forecasts at the moment have, the Chinese market going to about 70% LFP, and then assumptions that might be replicated in Europe and North America. I think certainly our view is that that's not the case, partly because China has far more exposure to the ESS side of the market. The vast majority of batteries going to energy storage systems come from China, and that's very much an LFP game because energy density isn't as important. In the Chinese market, you also have far more charging infrastructure. So people mind less about range anxiety and charging anxiety because there are simply more chargers. Cost is more important in that market. And also you have a very developed high-speed rail network, so that people don't necessarily do the long journey distances that we do in Europe, or certainly in North America, where people drive much longer distances with less charging infrastructure. And that means that the majority of material there is still NMC. We've seen it obviously a couple of announcements on this sort of mid nickel and high manganese content material from GM, from LG, etc. Ford over the past couple of weeks. That's likely to be, I think a good sort of mid-tier cathode choice. And then also we expect to see a reasonable number of LFP projects coming on, particularly in Morocco, where you've got that access to phosphate as well. John, any comments there on the European and North American landscape?
Yeah, so I think that obviously OEMs are actively trying to explore cathode active material options in Europe at the moment. And there's a real effort to try and strike a balance between performance and cost. And obviously, from the perspective of entry level segment, LFP is a very good option. But, as Andy's just shown, there's limited availability in terms of operational capacity at this point in time. And I think in other segments, we're seeing OEMs want to reduce, obviously, their exposure to cobalt and nickel. So the manganese rich chemistries that we've already mentioned, I think, offer a good alternative on this front. But the problem you have again is the current capacity and planned capacity in Europe is all very heavily focused on high nickel. So, I think my expectation is that we're likely to see more partnerships across Europe as these supply chains are built out.
Yeah. And just a reminder as we go on, there's a Q&A function, so please do ask questions, and we'll have a sort of 20-minute Q&A towards the end, and those can be asked either with your name or anonymously. So here we've got effectively, what our current view of the likely balances for cathode active material are in North America and Europe, and you can see, both markets on current announcements seem to be very heavily dependent on Asian imports. And indeed, if you look at most of the capacity that is being built in Europe and North America, most of that is with some kind of Chinese involvement as well. So obviously that potentially creates more of a problem for North America, because effectively, what we likely to see, or at least in current drafts of the budget bill, we're starting to see China being cut out even more from subsidy regimes. Now, that could change very quickly, but at least that's where we are today. Another thing that we're seeing is that a lot of the OEMs, particularly at the C-suite level, are seeing that battery prices are now cheap, seeing that raw materials are cheap, and saying, look, the supply chain's responded. We don't need to worry about this anymore. Or we're going to delay our decisions while we relook at our strategy. And it's a very similar situation to where they were, 5 or 6 years ago, before we saw big price increases impact on those markets. And John's going to talk about that a little bit more in the slides to come. But there's a little bit of deja vu there. I think probably the difference is most of the OEMs do now have raw material purchasing teams who understand the markets. But whether their voices are heard is a different thing. Just a note on the current sort of state of play in the US. I think what we're currently seeing is that the 30D tax credits are likely to be phased out under new legislation relatively quickly, and that the foreign entity of concern language will move into the 45X part. This is the sort of production tax credits for industry, and that there'll be some kind of sunlighting on 45X as well. At the moment, the language on foreign entity of concerns has been strengthened quite a bit, and that could potentially exclude China from large parts, or any Chinese material, any Chinese expertise from large parts of the Chinese of the North American supply chain, or at least the US supply chain. To be honest, that's actually a threat, because it's going to have an impact on how good US EVs are going forward, and how expensive US EVs are going forward. So I think again the potential for the energy storage sector and the potential for the electric transportation sector in the US is certainly under quite a bit of threat from the current language in the legislation. I'm not going to spend any longer on that, because it's probably changed since I've been speaking. But yeah, I've just to really paint the picture there that there is this huge shortage still of the midstream, still of cathode capacity, and there are a number of challenges that the industry is facing to try and fill that. We've got the vehicles, we've got the plants, we've got the batteries, we don't have the cathode active material, we don't necessarily have the lithium refining, and we don't necessarily have the mining. With that, John, I'm going to pass over to you to look a little bit about mitigating risk and what we can do.
Thanks, Andy. Good afternoon, everyone. So in this section, I think we'll look at three key topics. the impact of raw material prices on cathode costs, pass-through mechanisms, as well as the impact specifically on OEMs. So CAM prices are heavily impacted by raw material price volatility. The graph here shows effectively the impact of raw material price changes on NMC 811 cathode active material. And as you'd imagine, lithium and nickel variations have a sizable impact on the total cost. These variations in prices effectively will be passed through the supply chain and will stop with the OEM, who will have to either absorb them or pass them on to their customers. So looking at the importance of pass-through mechanisms here, as Andy's alluded to, right, we're in a low pricing environment. So the pressure is off at this point in time in terms of necessarily addressing these pass-through mechanisms proactively. But OEMs are exposed to raw material price swings, and current low prices are creating somewhat of a false sense of security for the end users in this market. And I think as well, the low pricing environment has only delayed much required project financing we spoke about earlier. A lot of these projects that need to come online have not received the required financing, and as a result, their timelines have been pushed out. And that's only going to have a more severe impact when we look at the price response. And as I mentioned, that will effectively be passed directly down the supply chain, and OEMs will have to deal with that situation. Next slide, please. Thanks. So how exposed are OEMs at this point in time? The graph here shows the total cathode active material cost per 100,000 vehicles for both LFP and NMC CAM on both a high and low cost pricing scenario environment. So clearly you can see here at this scale that hundreds of millions of dollars are at risk for downstream players, effectively left on the table if they do not mitigate for these pass-through mechanisms we have mentioned. And these price variations can have a significant impact on the total CAM cost. So addressing this is really pivotal for OEMs at this point in time. And what options do OEMs have to address pass-through mechanisms? Well, they can explore hedging, if terminal markets are available, that is, and liquidity exists in those cash-settled derivatives. We're seeing obviously a build-up in lithium cash-settled derivative contract, which I think is positive for the industry to manage risk. There's still nothing on manganese, although it's obviously the smallest commodity in this segment. And I think also it's important to mention that it's not always easy to achieve 100% hedge. If you look at the nickel and cobalt cash-settled contracts, for example, and physically delivered ones, they're not specific necessarily to battery-grade products. And as a result, you're not going to achieve 100% risk mitigation on those products. The second thing that OEMs can potentially do is direct sourcing. So this obviously means they'll have greater cost control by going out and sourcing their raw material products themselves. They can negotiate their pricing points rather than be passed them on. And also, I think that it provides them with significant security of raw material feedstock, which is important in order to maintain operations. The third point is in relation to vertical integration. So obviously OEMs, and we've increasingly seen this in the supply chain, can deploy capital, take equity, or develop JVs, with players further on the upstream to provide security. The question arises when they do this is, where does the economic value sit in the supply chain? Because if an OEM, for example, invests directly in a mine, do they want kickback mechanisms at the mine level or further downstream? And this is something that we're supporting the industry quite actively in at the moment. So moving on to focus on the midstream, particularly the precursor and cathode active material part of the market. The midstream segment itself is particularly opaque. So the costs are not often indexed. Obviously, the raw materials are indexed themselves, but there's a lot of costs which make up the total CAM cost, including refining charges, which is essentially the processing of feedstock into battery-grade products. You have salt premiums, for example, which are charges for converting input feedstock into sulfates, drying and milling costs for lithium products, and transformation fees on top of that. So unlike all of the raw material indices that are indexed and you have transparency as they're passed through the supply chain, these costs are effectively negotiated with each supplier, and they're very opaque because obviously they're not indexed. So having some level of visibility and understanding on how to benchmark these costs is really imperative in order to control costs, particularly if you're at the end of the supply chain and don't necessarily get the full visibility and breakdown of the cost you're being passed. So I think the key points on this that I wanted to make is that, OEMs really need to be proactive in trying to manage these costs. Many OEMs are increasingly doing this. They're looking to feed raw materials into their own supply chains, and this is addressing some of the key issues. But it's also putting a lot of pressure on the midstream margins, because if you're obviously supplying battery grade material into your supply chain, there's no need to refine that material, for example. So this is obviously causing some conflict within the supply chain as well, but it's a good way for OEMs to potentially manage costs moving forward. So how is cathode active material priced in the market? Well, CAM prices are often based on pricing formulas. Raw materials, as we've already mentioned, nickel, cobalt, lithium, and manganese are all index linked. Some of those prices are obviously more mature than others and have greater liquidity, but at least you can peg it to a pricing mechanism. And then there's essentially a calculation based on their percentage content within the cathode active material. So that will give you your raw material cost. But additionally, on top of this, you have baked in charges, as I mentioned, such as drying and milling and salt premiums. And these are the real costs that effectively you need transparency on in order to negotiate with your cathode active materials supplier. Just so everyone's aware, this chart is based on 2024 raw material prices and is pegged against essentially a European cathode active material manufacturer. I think what's really important here, though, is it's critical to dissect these costs further and really focus on these non-indexed components. And we provide a lot of support in the market in regards to bringing materials partners. I don't know how at this point on this.
No, so I just lost your audio for a second there, John.
Oh,
so
okay.
I missed the last bit of what you said.
Oh, no problem. We can move on to the next slide then. Thanks. Yeah, so I guess the real question at this point is, why are OEMs moving up the cost curve? Moving up the supply chain. I think that there are significant benefits for them to do this. In terms of going to source provides them with far greater raw material security. But right now, this is a really hard justification in markets where you have depressed pricing environments. If, for example, a procurement team was to approach their board of directors in an OEM and look at, deploying capital in a mining asset at this point in time, it would be incredibly challenging to justify, even though realistically we're in a counter-cyclical investment opportunity. So it makes sense to obviously deploy that capital at this point in time. The second benefit would be in relation to price control. So obviously, if you go and source the material directly yourself, you have less exposure to raw material price volatility. You can negotiate your own terms, and often you'll get a good discount as well on the current market price, particularly if you deploy equity in that operation. So I think, there's a few other benefits in relation to this as well. You can select, obviously, your own input feedstock. So you can look at, whether you go out and purchase MHP as an example, or metal products. And this ties very closely into, obviously, your partnership with your cathode active material partner and what circuits they have to process material. But going to source and sourcing your own material obviously gives you a lot more control around cost, ESG, compliance, and quality. And I think that's really important for this market at this point in time.
Yeah, and it's just worth adding there that there's a huge amount of money that's being left on the table from not negotiating necessarily directly or relying on your tier one suppliers and relying on the supply chain. And that, ultimately, as we said, those middle parts of the supply chain are really struggling at the moment. They're struggling to expand. They're struggling to get financing. And largely that's because of oversupply in Chinese markets pushing down global prices. Yeah, it's not sustainable. And if you want a local supply chain, you can't just rely on government. The only government that we were relying on was the US government with the Inflation Reduction Act. That's now obviously gone a bit of the back burner, and we'll see what becomes of it. But in Europe, you never had that, and the critical Minerals Act doesn't really have any teeth to it anyway. So effectively, I think the OEMs do need to be a bit more proactive, and that can also, pay financial dividends. It can reduce supply shortages, the supply crunches like we're seeing in rare earths at the moment. It can reduce pricing volatility, and ultimately, if we look at what's likely to happen in the next few years, there is a potential, for some of the larger OEMs, $3 to $4 billion additional charge on what they're paying now for their battery supply chains, and a lot of that could be mitigated away by management now. But that's not necessarily happening. Um,
Agreed. Thanks, Andy. Could we move? Yeah, thank you. So just looking at this slide in particular, what factors should be considered when looking at direct sourcing? I think obviously, risk appetite is incredibly important. Where are you willing to deploy capital if you are and secure raw materials? Obviously, particularly OEMs, they have very strong, stringent ESG and compliance departments that often dictate a lot of these decisions as well. And also, I think it's important to understand, as I mentioned, the cathode active material partners processing circuits. Going out and sourcing the wrong product will obviously have significantly detrimental ramifications if you cannot essentially process that with your existing CAM supplier. I think also just to add as well, the availability of different circuits on the market for processing and different feedstock products is very important to consider when making these decisions about how far upstream you go, what products to source, and obviously where you process them and with which partners as well. So yeah, finally, I think as we've kind of covered as well, many OEMs are assessing opportunities to invest in mining, and I think that there are some factors that are incredibly critical in making these decisions. Timing is one of them. Obviously, at the moment, we're in a low pricing environment, and I think that, as we mentioned, counter-cyclical investment opportunities are out there right now. But it's going to take someone brave to make these decisions, particularly at OEMs at this point in time. And I think, there's also need for understanding the risk appetite and profile. 85% roughly of projects will face delays or cost overruns. And obviously, that's a difficult number to stomach if you're effectively deploying capital in the upstream of this market. Working with the correct partners is obviously fundamental. There's only a handful of players in this market that can produce battery grade lithium at the scales that are going to be required by most OEMs. And ensuring you select the right partners to work with on that front is incredibly important. So I think, maybe just a couple of final points on this. Making a decision whether to invest upstream, there are significant risks for OEMs, but there are ways in which to manage these risks and ensure that you can optimize the opportunity and the economics of your investment.
Thanks, John. And thank you all. So we do have a Q&A now. Please do make the most of that function. We've got about 10 questions already in there, so start going through some of those. First one, would you say it's a good time to start lithium exploration and mining? I'd say it's a good time to get involved in the lithium sector from an investment perspective. Valuations are very low. We've seen some companies, some very large companies take advantage of that to get an established position in the industry. I think one of the interesting things that's worth mentioning though is, we track about, 400 projects at the moment. Some of them aren't going in it, probably most of them aren't going anywhere. But there is enough that's already been found to basically cover the entire energy transition. There's no shortage geologically of lithium. So when people start talking about lithium in in war zones, in places like, the disputed areas of Ukraine, in Afghanistan. It's very unlikely that that's ever going to happen because there's plenty of material that's been discovered in low risk jurisdictions. Doesn't mean that there won't be new assets that get discovered and come online, but it is a competition from a geological perspective. There is no actual shortage of lithium. Next question was, can African supply limit any lithium price increases? Um, Absolutely. I mean, if you look at what happened in the last bull market, a large part of that ended because of increases in supply from Africa. And a lot of that supply has become more mechanized now, and actually has quite a low cost of production. We also see quite a few byproduct credits, helping that supply come to the market in markets such as niobium and tantalum. Um, One of the interesting things, though, is, and going back to my comment on the fourth quartile being incentivized before the second and third quartile. So I'm not talking about the sort of more mechanized, say, Zimbabwean assets there. I'm talking about a lot of the direct shipping or a lot of the tailings projects that entered the market in the last high price environment. A lot of that can actually expand quite quickly. It's more expensive to process from the refineries perspective, so they won't buy it unless there's a shortage elsewhere, but it can happen quite quickly. The other really interesting piece of news that came out earlier this week is that Zimbabwe, the largest African producer, is looking to ban concentrate exports from the beginning of 2027. They've already effectively curtailed, unbeneficiated ore exports, and now it looks like that market's going to have to move more and more, probably to a lithium sulfate product that it starts shipping to China in terms of value add. Is Zimbabwe going to become a really big battery grade hydroxide producer? Probably not. It's a very high cost place to do that. We've already seen what happens when you try and do very complicated things in markets where you don't necessarily have a huge amount of experience. So yeah, the two different aspects to future African supply. Next question, can you comment on the expected split between LFP and LMFP? John, do you want to go at that one first?
Yeah, it's a good question. I think that it depends what market you're looking into. Obviously, I mean in Europe at the moment, LFP is obviously entering that market and that space in terms of CAM development and cell development. I don't think we're likely to see LMFP in Europe for a couple of years at least, given the kind of development timeframes we have on existing assets that are being made. But when you look at China, it's a completely different picture. So obviously China now is heavily dominated by LFP and LMFP. And I think that, that trend is obviously going to continue. But I think that there's less appetite given the capital deployment that we've seen in Europe on the high nickel side of the market to switch variants at this point in time. So I think it'll be a longer development timeframe in Europe.
Next question, what is the expected battery price increase in the US in Q2 versus Q1? Interestingly enough, if you're producing a battery in the US, like the 90+% of those batteries are going to the automotive market, they are priced on a formula, which is effectively a cost plus formula. So if you've got, a battery being produced in Michigan or Kentucky or somewhere like that, its price isn't going to change. It's just going to change in line with the raw materials. The import price, and this is really important for the ESS sector, is basically, the current price plus the tariff. We, work with a number of the ESS companies, and if the tariff for Chinese batteries is 25%, they could just pay an extra 25%. Tariff's 40%, they could probably just pay an extra 40%. Any more than that, and you start getting to quite a bit of demand destruction because there simply aren't the domestic sources or the Chinese sources at the moment to get those ESS batteries into the market. So those ones, yeah, a bit more impacted by supply and demand fundamentals and tariffs, whereas the domestic batteries, those prices are set under a formula that actually isn't impacted by supply and demand so much. So the question is, two-thirds of lithium producers are losing money. Not exactly from that chart. So, the cash cost of production is quite a bit lower than we show on that chart, which is sort of looking more at the incentive price. But yeah, the vast majority are not making a large amount of money at all, and quite a few are losing money every ton that they sell. What do you view, and I'll ask this one to you, John, what do you view as critical for potential European refineries under development to become more competitive with China? Will regulation or EU intervention be critical to ensure competitiveness through mechanisms such as the Critical Minerals Act, battery passport, CBAM, etc.? And do you see a premium for European refined material developing versus China?
Yeah, it's a very interesting question. I think that when we're talking about European refineries, obviously the majority of them are not, well, all of them are not cost competitive at the current levels, right? And I think the challenge that we have at the moment is obviously Chinese material is available to purchasing departments, and it's incredibly difficult for a procurement team to justify to their boss to go out and pay a premium on European product because it's European relative to Chinese product that is significantly cheaper. So in that instance, you do need some level of governmental support or protectionism that is going to level the playing field to a certain extent and allow for these European companies to obviously sign bankable offtake agreements and then get the relevant financing that they're going to require to come into production. It's the only point I'd add is obviously everyone wants localization, but at the moment I think that it's very difficult for the people who are looking to deploy the capital to justify those investments at this point in time.
And sort of linked to that one, another question, how possible is it to achieve offtake contracts in advance, in the current pricing environment,
Offtake.
specifically for lithium refineries?
Okay. No, it's another interesting question. I mean, the difficulty I think that a lot of the new entrants face in the market is being able to sign bankable offtakes. And the reason for that is the credibility around qualification piece. So a lot of the question marks that would come in are in relation to whether they can produce the quality of material consistently, because we're talking about specialty chemical here, not a commodity. So obviously the time frame you have to qualify your material with your cathode active material producer can take up to a year. And in some cases, you don't want to be in a situation where you're effectively paying for this material to be qualified. It's not consistent when you can buy that material, which is guaranteed to meet the spec that you require from China, for example.
And how do you estimate or forecast your $20,000 per ton long-term lithium carbonate price? I think we're slightly below that, but not that far away from it. Effectively, the way we do that price forecast is we look at what the incentive price for the marginal supplier is. So we take our demand forecast, take our cost curve, and we say these group of projects need to be incentivized. We look at what their production cost is likely to be. We look at what their capital repayments are likely to be, and we look at what a reasonable margin would be to incentivize them. So, it's not taking the cash cost. You don't go in and build, spend hundreds of millions of dollars to produce a mine just to not be able to repay your debt. And not make any financial return. So the incentive price is always quite a bit higher than the sort of cash cost that you'll see reported in a feasibility study. Next one, is it a good time for CAM and PCAM production startup in India? What are the challenges for starting up? I'd say it's a very good time for the Indian market, actually. You've got a huge amount of demand. I think you're starting to see a little bit of an opening up of the Indian market to foreign direct investment in the automotive side as well, which is going to be very positive for electric vehicle demand on top of the sort of Indian champions that we're seeing moving forward, the Tatas and Reliances of this world. And those companies need supply chains, and there's no reason why you couldn't have that PCAM and CAM facilities manufactured in India. Indeed, it's probably, India's, if we drew a chart similar to the European and North American ones we had, showing a gap of cathode active material and PCAM, India would look very similar in the current environment. Next one, in the DRC, we have lithium deposits. Will it be advisable to invest millions in new projects looking at the decline in the market currently? The DRC in some respects isn't that different to many of the others. There are some fantastic assets there. There are always questions over logistics from the DRC. I think, when the bigger question for the DRC is actually, how many companies can invest into that country, because there's a huge amount of transparency that's required in electric vehicle supply chains that you don't get in existing battery supply chains, things like toothbrushes or electric drills or lawnmowers or whatever, or that you don't get for internal combustion supply chains. And there's a huge amount of ESG requirement when it comes to these. So, John, I don't know if you've got a comment there on some of the barriers that you saw working in OEM for investing in developing markets.
Yeah, I think you framed it quite well. Some jurisdictions are more challenging than others to operate in. I think that some are, kind of ticked off the list immediately by some ESG departments. But I think that what's really important from an ESG perspective is to provide a roadmap for the development of these assets in these jurisdictions. And definitely in my previous role, we were working really closely with the ESG team to ensure that we could effectively, operate in or be present in some jurisdictions that effectively we would work with the local government and environment to ensure that, everything was done in a sustainable manner, and there were positive benefits as well. So I think it's really important to look at that aspect of things when you're making these decisions, rather than just kind of crossing jurisdictions off the list.
Perennial question is sodium-ion a substitution risk? Yes, the theoretical addressable market for sodium-ion is huge, particularly in energy storage systems, but also in some of the more cost-sensitive transportation side of the market. It's not really happening anytime soon at the moment, though, largely because lithium prices are so low and that industry scaled so much that a lot of sodium ion is actually more expensive than lithium ion at the moment. The different ways to look at costs, certainly sodium ion performs very well in a low temperature environment. But I think what you'll probably see is sodium ion, increasing its share quite a bit in ESS and starting to enter into the transportation sector. But it will take until the next lithium price boom before we see the next sort of surge in sodium ion rollouts. The other thing to mention is that it's a Chinese industry at the moment. People complain about lithium ion batteries being China dominated, and they're letting exactly the same thing happen with sodium ion, which is quite interesting. Thoughts on lithium manganese rich as an option, alternative to LFP and LFMP, in light of the Ford and GM announcements? John?
I don't necessarily see it as an alternative, more an enhanced product. So I think that, from that perspective, manganese-rich chemistries are definitely very high up on the focus from the demand side. A lot of people are looking into ways to reduce cobalt and nickel exposure, and I think that manganese-rich chemistries really offer a good solution to that in terms of cost. When you look at the bill of materials associated with nickel-intensive cathodes relative to high manganese cathodes. The high manganese cathodes are obviously cheaper. It reduces your exposure to some of those more tricky commodities, let's put it that way. And I think that there's definitely a place in the market for high manganese. It was definitely going to increase over the coming years. It's just a case as to what extent, given the capital deployed in high nickel at this point in time.
And I'll add an objection to LMR as an acronym. It's an NMC battery. It's a ternary cathode battery. It's just got a higher amount of manganese. Still uses nickel. Still uses cobalt. So it's a bit of a marketing term, trying to make our spreadsheets more complicated than they already are. We have another 5 minutes to go and quite a few questions. I'll try and get through to a few of you after the call. What do you see as the evolution of spodumene ore in concentrate grade? Is SC6 still the most widely traded grade in practice? Nope, that hasn't been for a long time. You're sort of looking at mid fives. I think it's only really Greenbushes that does the 6%. There are a few others that can do higher or higher grades, but yeah, we've seen a trend for a couple of years to have slightly lower spodumene grades. John, any comments on that one?
No, just obviously, there are price adjustments based on the lithium content associated with different grades in spodumene pricing. So that's something we look into in a lot of detail as well.
Yeah. Do we foresee lithium demand from ESS to outpace transportation in the near, medium, or long term? No. And the reason for that is the ESS market is far more prone to disruption, basically from different technologies. They're only using lithium-ion batteries because lithium-ion batteries are cheap because of transportation. When you're putting shipping containers in fields, you don't need necessarily the high energy density. You really just care about cost. You don't care about weight so much. You care about cost. And that opens that industry up to more things such as sodium ion and also different battery technologies and also different ways of storing energy, completely. So, looking at different ways of medium and long-term storage, whereas, the batteries, lithium-ion batteries are very good at 2 to 8 hour duration storage. So that overnight storage, they're not very good for medium or long-term storage compared to some other technologies. So I think you'll see quite a bit of disruption in energy storage systems going forward. How do you look at the resulting impact on demand and supply equation and pricing of cobalt, which is trying to make up its prices, which had touched lows? Cobalt's an interesting one because there's far less that's used in a battery now. In some respects, it's immaterial. And quite often OEMs are only really purchasing it because they can purchase it with their nickel at the same time, if you're purchasing from outside of the DRC. So, cobalt, from our view, still in a huge oversupply. Obviously, you've had the restriction of exports from the DRC, which has led to a bit of a supply shock. But ultimately, inventories are very high across the supply chain. You're seeing a large amount coming from Indonesia going forward, and a large amount more coming from the DRC, off the back of different copper investments. So, we could talk for hours on cobalt, but it's an interesting one. And again, it's a bit of a victim of being a byproduct in almost all markets. That brings us to time. John, I don't know if there are any other questions which are standing out to you that you want to answer right now.
Not that I can see. We can follow up on some of these afterwards, of course.
Yeah, I think we'll have to do that because apologies, there are about 15 more questions here that we will try and get back to you all. But thanks all for staying with us. And I say, please feel free to reach out to my colleague Derek. His email address is there if you'd like to learn more about our products or just have a little chat about the markets. But for today, thank you all.
Thank you very much.